Hello and welcome to our YouTube channel. In today's video, we'll be talking about the technical analysis part 3 using trend lines. In technical analysis, transitions between rising and falling trends are often signaled by price patterns. By definition, a price pattern is a recognizable configuration of price movement that's identified using a series of trend lines and/or curves. Trend lines help technical analysts spot areas of support and resistance on a price chart. Trend lines are straight lines drawn in a chart by connecting a series of descending peaks or highs, or ascending troughs or lows. But before we dive deeper into the technical analysis part 3 using trend lines, like this video, smash the subscribe button, and click the notification bell right now because you'll see how to use trend lines, which will definitely help you become a more profitable trader. Trend lines are amazing tools to visualize the trend and spot potential reversal points. Traders, however, usually don't draw them properly. They try to make the market fit the line instead of making the line fit the market. This misuse of trend lines often results in major losses for traders. So how do we use trend lines? Based on the highs and lows of a chart, trend line indicate where the price briefly challenged the prevailing trend, tested it, and then turned back in its favor. The line can then be extended to try and predict important levels in the future. The trend line may be tested several times, but as long as it isn't broken, it's considered valid. While trend lines can be used in all kinds of data charts, they're usually applied to financial charts. They provide insights into the market supply and demand. Naturally, upward trend lines indicate an increasing buying force. Downward trend lines are associated with consistent price drops, suggesting the opposite. However, the trading volume should also be considered in such analysis. For instance, if the price is increasing but the volume is decreasing or is relatively low, it may give a false impression of increased demand. Well, how to draw trend lines? Trend lines are drawn based on the highs and lows of crypto price charts, connecting 2 or 3 candlestick tops and bottoms. An ascending trend line is drawn from a lower to a higher chart position, effectively forming higher lows, whereas a descending trend line is drawn from a higher to a lower position, therefore showing a lower high. The key difference between drawing a trend line is the choice of points used. Most technical analysts, however, would argue that in order for a trend to truly be valid and have maximum certainty as to what does a trend line show, it shouldn't connect or tap using 3 or more points. Understanding the direction of an underlying trend is one of the most basic ways to increase the profitability of making a successful trade because it ensures the general market forces are working in your favor. You're probably wondering, why do we use trend lines? You can use trend lines to show specific zones that potentially have many buyers or sellers. This can cause the market to make certain movements from these zones. As with support and resistance, the rule is that the more a trend line is touched and not broken, the stronger the trend. When a trend line is actually broken, you often see the trend line being tested again. When this trend line is successfully tested, the trend line often reverses. Generally, trend lines are more reliable at longer time intervals such as daily and weekly charts. Never forced to make a trend line fit the graph as well as possible. Many traders try to adapt the trend line to their market expectations, so stay objective. Even if a trend line seems to fit exactly in the graphics, this line cannot give perfect signals. Use trend lines as a complement to your strategy, but don't use it as your only strategy. Trend lines are useful trading tools to implement in your investment strategy, as they can help you to make more profitable trades. When prices touch a trend line, it gives you an opportunity to enter the markets with the main trend. When price breaks a trend line, it's usually with higher trading volume. Potential buying or selling trading opportunities will appear once a trend line is retested after being broken. A trader can use trend lines to identify opportunities in either a bull or bear market, and within any chart time frame. However, be mindful that signals generated on minute charts have a greater possibility of being false signals due to the smaller amount of data they contain. While they are useful tools for technical analysis, trend lines are far from foolproof. The choice of points used to draw trend lines will affect the degree to which they accurately represent market cycles and real trends, making them somewhat subjective. Do you think trend lines are useful to traders? Let us know your thoughts about this video in the comment section below. We hope you enjoyed and learned something from this video. If you did, make sure you like this video, subscribe to our channel, and turn on the notification bell down below for more upcoming videos like this one. Thanks for watching!